Welcome to the Jones Zone, a podcast by Darryl and JJ Jones, your resource for building wealth and knowledge in everything real estate. Your host, Darryl Jones, a top Orange County real estate agent, has been supporting homeowners for over 30 years. He is here to share his tips and advice, as well as insights from industry experts to help you take your real estate game to the next level. Now, here's your host, Darryl Jones.
In this part 2 of Tax Talk, the benefits of selling a home, we discuss the tax implications of selling a primary residence versus an investment property, and how some strategies, such as a 1031 exchange, can help reduce the tax burden. Pat, tell me, how do tax implications differ from a primary residence versus an investment property?
So for a primary residence, we can deduct interest. When I'm selling the property, of course, if I've lived there, assuming I've lived there and I've owned it for at least 2 years, then I can enjoy tax-free gains of up to $250,000. That doesn't apply to rental properties, unless, of course, within the last 5 years, I have a hybrid of living there and renting it out, right? So I got to look from the date of sale, last 5 years, whether I have lived there for at least 2 years, and then I would qualify for the home gain exclusion. But if I have not, and I'm selling it and it's completely rental, like rental use all the time, I don't get the home gain exclusion. And all of those profits would be subject to capital gains tax.
Home sale inclusion being the $250,000
right
tax-free gain
right.
that the government allows you to have when
right.
it's your primary residence.
Right. But if it's a rental
person.
property, it's all subject to capital gains tax unless I do a 1031 exchange. Or, of course, also unless I've got losses that have rolled over from past years, or also unless I can do a special strategy this year, which we have. Interestingly, I've got tons of stories. We have another story where a client sold I think like a fourplex in Long Beach, and they were going to have gains, like taxable gains of about $600-ish, almost $700,000. When you do the 30% tax on that, that's a pretty sizable bill,
Yeah.
right? So we did a special strategy. They have other properties too. So we did a special strategy to basically beef up some deductions that year. That same year, we got to time it all in the same year. And instead of writing a check to the government for like, say, $250,000, they got a $30,000 refund.
That's amazing. Absolutely.
Special strategies.
I have people sometimes will complain about, let's say, costs of things, but to pay a qualified tax consultant,
right.
Quite a nominal fee compared to $200,000 plus.
Oh yeah, absolutely.
It's not even it's a no-brainer. It's funny. It's the old saying I've heard where you think a really good attorney costs a lot of money, hire a bad attorney.
Yes.
That'll cost you a lot more.
Yes.
So. Same is true with tax people. I know
They try to penny pinch, and I always tell them, hey, the taxes you pay to the government is not deductible. The fees that you pay to a qualified expert is fully deductible.
Oh, there's another reason. Like we needed them. We didn't even need another reason. That too. So the 1031 exchange, can you explain how estate taxes may come into play when selling a home? Or maybe you've got some clients that have had issues with that.
Yeah, sure. And this is assuming the home is part of the estate.
And what do you mean by that? It's in a trust.
So the homeowner needs to set up a revocable living trust, not just a will. A will is just your desire of what you want to do. The trust is the legal instrument, but not only setting it up, but titling the house to the trust. So oftentimes we've seen where an individual might go to attorney, set up the living trust, and they designate who's going to inherit my assets when I die, blah, blah, blah. And then they forget to put the house in the trust. That's no different than opening up a bank account and keeping the cash underneath your mattress. It's not in the bank account.
Yeah.
So in that case, when the person passes away, the house is not titled to the trust, then what happens is it can open up what's called probate.
I've got 2 clients going through probate, and that can be costly, very time consuming. That's for darn sure.
Very consuming. I have a horror story. I got a client where they are an elderly couple. So her husband's nephew, so, he's in his 50s, not married. His parents have passed, so he's the only one. All of a sudden, he passes from a heart attack. and he's got some assets. So the probate court comes in and determines the next of kin, which happens to be my client's husband. So they go through probate. My client's husband is the next of kin, is supposed to inherit all that. And this is during COVID. So you can imagine how long that got dragged out.
And while that's being dragged out, if there's a mortgage on the house, if there are utilities on the house.
That's at risk. That's all at risk.
All that. So theoretically, could a probate take so long that, and the person, let's say someone inherits it, that they can't make the payment for whatever reason, and it could be foreclosed on. I'm not to be doom or gloom, but
possibly
there's another reason not to make sure you have your house in a trust. And that's a whole new podcast that we'll have.
But to continue on that story, the first probate was not resolved. Lo and behold, my client's husband passes.
Wow.
So this is a probate with another probate. And that got dragged on for years. Years.
Wow.
And all the simple fix to that was
that property's jinxed. Everybody that owns it dies. You don't want to inherit that property.
Yeah.
Wow.
It's number 13. The house is number 13. Just kidding. So a living trust is a simple fix that anyone who has assets, whether it be a house, a business, it could be an individual, a single person, a divorced person, a very young millennial, or even Gen Xer who, creates a business and takes it trajectory to the roof. They need a living trust to designate who's going to inherit their assets. Otherwise, there's no estate. At that point, then probate court comes in, and that's the big nightmare.
And the primary benefit is there are additional costs in probate, a lot of costs, and then delays and timing. Correct. But as far as if one inherits a house through probate or through a trust, that in terms of the inheritance tax, that's the same.
Correct.
Okay.
Right. It's getting to that inheritance tax. That's the journey. That's the trick. If you could just get to that point, then you're in good shape. For someone who inherits a house, they then get what's called a step-up basis. So let's say, parents bought the home for $50,000, way in the days. It's pretty common, I know.
Yeah. Oh, yeah.
And we're not talking about like ages ago. Like one of my best friend's parents bought their home in what is now called Sherman Oaks. They bought it for $50,000. And funny thing is later they bought a car for also $50,000, same price as the house. But the house is worth well over $1 million, right? So if let's say my friend inherits the house, she's going to get a step-up basis at today's value
of $1
million. And if she turns around and sell it, also at $1 million sale price minus $1 million step-up basis, she walks away with no tax.
All you have to do is die.
Yes, and put in a trust. But if this is in the probate, we're not touching the house until probate.
That's a big difference.
Oh, yeah.
It's a no-brainer. Because I think possibly the reason is, people don't know. Hopefully this will help more people know about this. And the cost of setting up a trust isn't free. So you got to pay
you're talking about like maybe a few thousand versus like add another digit?
That's exactly why I was bringing it up, is you're saving pennies and it's costing you dollars.
Right. Yeah. Depending on how complex it is, I'm not an attorney, of course, like perhaps, starting at $1,500 versus, several thousands, depending on how complex or how many assets the person has. But once they set it up and they designated their beneficiaries, then also the important thing is titling the assets to the trust. That's the key. I have another story where a client, single lady, owns probably a dozen rental properties. And so I said, hey, so you have a living trust? Oh, no, I don't. I'm going to leave it all to charity because I hate my family. And I said, sure, that's great. Let's get that trust going, because if something happens to you, guess where it's going? To your family that you hate, because the court will go to the next of kin. And next of kin ain't going to be the charities. It's going to be your family.
So in order to leave it to a charity or where you designate, it has to be in a trust.
Oh, absolutely. Or else the court's going to come in and their line of order is next of kin.
It's interesting on that note, because I've been hearing lately, I think there are commercials on television, in fact, or whether it's radio or podcast or whatever, that you can donate a house. And maybe this isn't exactly the same thing, but can you speak to that? Donating a house to charity and the tax write-offs that involves?
Yeah, so a few things to that. So some people think that, hey, I've got an Airbnb, I'm going to donate like 1 week. That's not going to work. To really qualify for that, you need to donate the entire house. And there's many options to that. So, that might be a topic that an estate planning a lawyer can expand on, but there are multiple options. You can donate the house, but keep the income. Let's say I have a rental property or a rental apartment. I can donate the apartment, put it in the charitable trust, but I keep the income while I'm alive. And I can rent it many ways, or I can just...
And you would do that before you
you got to do it before you die, because nobody can speak to the dead.
It's important that I remember the questions I ask, huh?
Yeah, that's great. That's a great question, because that's going to take another skill to speak to the dead.
So, Pat, tell me, how can a tax professional assist homeowners? Maybe walk me through what your typical interview is, or when someone comes to you. How can a tax professional assist homeowners in navigating the tax implications of selling their home?
Yeah, sure. So when folks come to us, my first question is, why are you changing accountant? There's a reason. Or maybe they've never had an accountant. That's a separate story. And oftentimes it's because, one, they've outgrown their accountant, basically. They now have issues that their accountant is not able to address. And they get a feeling that their accountant perhaps is not brushed up or well-versed in real estate taxation. And that's where a lot of our clients come in, where they've got rental properties, they've got perhaps a business or some sort of more complicated situation that it's beyond the scope of their current accountant. And we come in, I do an assessment of where they're at. We always look at the prior year return, because I want to see if there's any leftover deductions, or maybe perhaps if they missed opportunities, which most of the case, it's pretty common, especially with the 2018 tax reform, the TCJA. Many business owners, their accountants have missed deductions. So we take a look at that. We see what's been missed, and perhaps there might be an opportunity to amend the tax return and get some refund back. Or if not, then we take a look at the assessment of what they have changes this year, and we do a game plan for them. So it's a lot different than just preparing, or what they call doing their taxes. We plan forward looking. So instead of seeing our clients once a year, during tax time, we like to have frequent chats with our client to touch base with them, checking with them what they're doing. Hey, Darryl, there's some new tax law changes, blah, blah, blah. Probably bug you more than you want us to.
All right. What is the most money you saved a client? So if they wouldn't have come to you and you wouldn't have discovered this, they would not have realized this savings. Tell me that.
The most savings I say that we did was easily in the 7 figures.
Annually. So $1 million plus each year.
Correct. So new clients, prospective clients come to us. I always give it a fresh look and ask myself, what would I do differently to add value to this particular client? What changes would I make, and what opportunities have they been missing? So for this one family, they have a core business, and they have a bunch of investment properties between commercial, apartments, mixed bag. And when I looked at it, they sure were missing out on a lot of the new tax law changes that came out as a result of 2018 tax reform, and a few others that have been around that the typical accountant wouldn't be aware of. So
to your point of specializing.
Exactly. Specializing and always keeping updated with all of the tax law changes. And there's never a shortage of that. It's constantly changing. So for this one family, I mapped it out. It took me several hours because the volume of entities that they have and the volume of work. Mapped it out, and I thought, well, easily, if they just follow my plan, they could save $1 million every year. Minimum $1 million. I always like to go in with a low expectation and deliver high.
Sure.
So I said, it looks like we're missing $1 million. You guys are overpaying by $1 million every year. And sure enough, we did a few restructuring, and really, mainly it's me doing a lot of the work for them. We're not talking about them changing massively on anything. It's just a few tweaks. I said, I think we could get you at least $1 million of savings every year. So sure enough, the first year we finished it, and they got a check from the government for $4 million. And they took a picture of it and sent it to me.
Oh my goodness.
$4 million. And they said, is this a scam? I said, oh, well, I don't think so. And the funny thing is, we always when I go, deposit it. And I'd be curious to see how long the bank's going to put a hold on that check.
5 years.
Yeah. So that's every year.
So it was a reversal of actually more than $4 million, because what would they have paid if they didn't implement the changes you suggested?
That I didn't calculate, but for sure they're not going to be getting a $4 million refund check.
Right. So it was easily $4 million
Yes.
that they would not have gotten if it wasn't for years.
They literally thought that check was a scam because they've never seen a refund of that size. They've only been used to paying the government, so they've only seen money go the other way, not back to them. So that was a really good story. And I've always loved sharing that one. But that is if, the client has to be cooperative and work with us. It's kind of like going to the gym. You can sign up for the membership, not go there, and you won't get any weight loss.
Right, right.
So,
but for $4 million, I think it might be worth going to that gym.
Well, we did a lot of the work for them. They didn't even need to go.
Wow. And
that's the whole thing, that we actually map it out and we will help them execute it. We will handhold the client to make sure that it is done correctly. And the last thing you need is for me to say, Darryl, go do XYZ, and you go do it, but you go off tangent. And at that point, we've missed the opportunity and it's going to cost more to fix what you've done. So instead, we actually take charge of that and help our client execute these plans.
Wow, that's incredible. $4 million, that's every year. Now, tell me, how long have you been doing this, by the way?
Oh, now you want to date me.
Uh-oh. Folks, she's only 24 years old.
Yes, yes. Child prodigy.
Yes, exactly.
I'm 21 again. I've had my own firm for about a little bit over 10 years, and it was in the industry for like another 10 years prior to that. Thanks to the massive layoff of 2011, it brought me here today, actually. So 10 years in the making, and I see lots of different clients. And all of these stories, all of these great stories, not so great stories, are all because of the different folks who we have the fortunate to cross path with. So that was a really positive, good story. On the flip side, it's a horror story. You can't make up the stuff. A couple who owns probably about 20 or so rental properties, and they held in the wrong type of entity. An entity is like an S corporation, C corporation, LLC, limited partnerships, etc. You got your garden variety. And they put these rental properties in the wrong type of entity. Now, I say they, the reality is it's been done by a CPA. So a lot of these mistakes, including the one that I just mentioned with the $1 million saving, again, all of that missed opportunity was not because of the client, it's because they had poor guidance. Right. It is always the CPA's fault, right? If just like children, if you got bad children out there, it's because we look to the parent. The parents are bad. So in that instance, we cannot undo. If the rental properties are held in the wrong type of entity, it is very difficult and perhaps impossible to undo. So in that particular client situation, if we were to unwind it, they would have had a tax bill of $330,000. This is 10 years ago. It would have been a lot more today.
Right.
So it is that critical when, people say, I'm in the real estate business. Well, there's a lot of things you can do in real estate, right? You could be a realtor. You could be a property flipper. You could be a developer. You could be a landlord, a whole ton of variety of stuff. Every different revenue stream, every different transaction has different tax treatment, and we have to select the most appropriate type of entity. Using the wrong one is highly detrimental. In this case, the couple with the rental properties in the wrong type of entity, we can't fix it. It is still trapped in there.
It just is too costly. It's cost prohibitive to
From
fix.
10 years ago to fix it, it would have cost them $330,000. Nobody would want to fix that. So their option right now is just to slowly sell these properties inside this entity. And they are going to come with some tax exposure. Then at that point, it's up to us to find what other means to reduce that exposure.
And save them some money and correct the problem.
I think we're at that point, that particular client, they are looking at liquidating all of the properties between this year and next year. And we are looking at some avenues to bring their exposure down to a very minimum. Maybe that could be a good story next year.
Yeah. And they would just 1031 exchange it into...
No, because keep in mind the 1031 is still within that entity. It's the entity that does the 1031. If you do that, it's
right,
prolonging
right.
that.
I got
they
it.
just have to
right.
sell it.
Because when you do a 1031 exchange, in fact, to explain that further, I'm catching on now. It has to be, if you own it as, let's say, DJ Quadrant, then you have to buy in DJ Quadrant.
Correct.
And that was where their mistake was. So
Exactly.
you can't do that.
Correct. So they're just prolonging that mistake. So at this point, the only out is to sell the properties. They will get that gain. Then we have to look at other avenues of where can we get some write-offs to offset that gain.
Wow, that's incredibly helpful. But I so appreciate you being here again. You're just a wealth of information that I think most people are going to find extremely helpful. How can our listeners find you, Pat?
Thanks a lot for having me on the show. Thoroughly enjoy our chat together. So folks, you can find me through our website at leungtax.com. So that's LEUN like Nancy, G like Greg, tax.com. And our phone number, 949-430-0338.
Oh, that's wonderful. Yeah, accountants don't do a lot on TikTok or Instagram.
They do, but I don't.
Okay. Yeah. I don't either. Thank you so much, Pat, for sharing your knowledge. This important topic. It's been a pleasure having you here on our show today. Selling your home, it can be a complex process, and the tax implications can be confusing. We hope this episode has helped you all have a better understanding on the tax rules surrounding home sales. And maybe by following these tips, you can help minimize your tax bill and make the most of your home sale. And if you've ever wondered about donating a home to charity, or if you might need a revocable living trust, stay tuned. Thanks for tuning into The Jones Zone, your resource for building wealth and knowledge in everything real estate. If you found this information and insights shared in today's episode valuable, be sure to head over to iTunes to rate the show, leave a review, and subscribe so that you don't miss another episode. Remember, when it comes to real estate, knowledge is power. Stay informed and stay ahead of the game with us. I'll be back next week with even more expert advice and industry insights. Don't miss it. Thank you.